Good evening, everyone. Thank you for joining us today at the Access Mutual Fund uh, e-meeting. Today, we have got Raghav Iyengar, who is the Chief Business Officer, and Devang Shah, who is the co-fixed income head. And we'll be talking about the implication of the recent changes that has happened in the debt mutual fund. Over to you, Raghav, sir.
Thanks, Shoaib. Good evening, everyone. Thank you so much on behalf of Axis. Thank you so much for taking time off. I know it's a working day, and we've kept this deliberately latish in the evening. I know we are possibly a bit late in this webinar, and I think a lot of what has happened on Thursday evening and Friday morning has got discussed quite a lot over the weekend at various chat forums. If you go to Twitter, for example, I think this is the hottest trending topic right now on mutual funds. I've been in the industry now almost 25, 23, 24 years, and every year I used to have a little bit of a BP spike whenever the budget was getting presented because, one constant worry in the back of my mind was when will this taxation mode get changed? Right? And I think, in fact, when it happened on 1st Feb this year, and I didn't see it in the budget, and even in the notes, I said, okay, we've got done for another 1 year. But then this suddenly happened over Thursday night. So that's water under the bridge. I think the good thing about the product is that I think interestingly there are a lot of advantages that are yet available for fixed income investors. Just because a certain taxation change has happened doesn't mean the end of the world. It's a very small component of our personal savings, fixed income mutual funds. I think largely Indians are yet quite traditional in saving for in the fixed income space. A lot of money even today goes to traditional products like bank FDs, corporate FDs, chit funds, etc. Where I think the biggest advantage is that you have now a certainty of return. This is a mutual fund, which is when you invest, you really don't know what kind of returns you can get. Right. I think the three large advantages yet accrue to mutual funds. I think one is, I think the biggest advantage is that mutual fund returns are a combination of interest and capital gains, which is mark to market. And I think that also is the reason why many investors have not selected mutual funds as a preferred fixed income investment option because by nature, fixed income instruments are supposed to be more predictive. So when you know that when you go to a fixed deposit, you put 100 rupees today, at the end of 1 year, 2 years, what you're going to get. In a mutual fund, it is a function of various things. Of course, large parts of the income accrue thanks to the interest that comes to our portfolio from the securities that we hold. And of course, a large part accrues from the prices that go up and down. So sometimes when prices go down, obviously people have not understood, or even for many large investors, even today, the price of a bond going down is something which is anathema. They don't understand that, but that's the way it's a very transparent way of valuing your exact securities. So hypothetically, last year, if you had bought a fixed deposit at 6%, today the same deposit is available at 7%. You've technically lost a percent by not investing it today. That's what a mutual fund does for you, and vice versa. When invested today at 7 and next year it goes to 6, there's an element of capital gain. But typically, if you hold it over a period of time, those price fluctuations tend to sort of even out. Number two, and a big one, is that I think unlike other fixed income products, you do have an element of deferment of tax. So you really don't have to worry about until you actually remove the money. So if you're really looking to build a long-term fixed income portfolio and you're looking to say invest for 25 years, 30 years, you don't have to worry about the yearly incidence of that tax because till you actually take out that money, the tax will not hit you. Right. And lastly, of course, is you have this whole flexibility of taking out how much ever you want. Now, on top of all this is the most important argument, which is that ultimately, what does a mutual fund do for you? It gives you a portfolio of securities. I think, let's say, hypothetically, if you were in the US today and you had all your money in SVB a month back from now, I think you would have had many sleepless nights, especially if your deposit in that bank was over $250,000, which was the limit of where the FDIC or the Federal Deposit Commission was guaranteeing. Of course, right now we know that they're guaranteeing all deposits, but at that point of time, if let's say you had $1 million, technically you were down by 7.5. You were down 75% on your portfolio day one, right? Now that doesn't happen in a mutual fund. Very rarely. One, I think it's extremely well governed. I think the regulator has done an amazing job of sort of managing the risk around these portfolios. We are very clear that these are portfolios meant for retail investors. So the degree of safety is very high. Number two, the degree of transparency is superb. in no other financial instrument do you get the kind of granularity that you get in a mutual fund. I mean, we can tell you almost on a weekly basis where products are investing right down to the last percentage data point. So you can actually, if someone is keen to actually see what's in their portfolio, they can do it. So I think these four big benefits yet there. So largely, I think. So can we go to the next slide? Thank you, Shweta. So I think everyone knows this. I think so. I'm not going to spend too much time. I think the good or bad, the good thing is that whatever you have invested so far, there is no impact on that. So hypothetically, if you had put money even today, or you can put money tomorrow or on 31st, so anything up to 31st yet enjoys the benefit of the what we call the existing tax regime, and any money that comes in after 1st April is typically what will not get those what we call LTCG, long-term capital gains benefits with indexation, right? So I think there is an immediate opportunity, and we are seeing a fair amount of interest now. People who are looking to sort of, especially smarter investors who have long-term money, who are looking to do it maybe in April, May, June, are actually advancing their investments and are putting it here. So one immediate takeaway for all of you who are on this call, we have 2 days. Unfortunately or fortunately, March 30th is a bank holiday in Bombay, market holiday on account of Ram Navami. So there won't be a purchase date on that day. But whatever you do between today, tomorrow, and of course on 31st is important. Now, importantly, please understand 31st means allotment on 31st. Just by giving a check on 31st, it doesn't work. The regulation is very clear. Money has to be received in the scheme account before 3 p.m. and for the NAV, and you have to give us a valid application. So whatever you have, please try and do it tomorrow. 31st is also a weird day from a transaction perspective because a lot of transactions tend to happen, and we have seen a lot of our life today, unfortunately or fortunately, revolves around systems, and systems have gone a bit slow, broken down. So if there's something that you can do and you have not done in the last 24 hours and you're waiting for 31st, my request is please sort of as soon as this call is over, try to advance that to whatever you can do. So clearly, one good thing is that I think there's something called grandfathering. So obviously, grandfathering means that whatever has been done continues at the same rate. So if let's say if you had invested last year or 5 years back or 10 years back, the same tax treatment applies. This bill effectively means that whatever investments you do from 1st April onwards will not enjoy the benefits that you have had so far. What it will do in terms of new products, in terms of new thought processes, I think there are a lot of solutions that are available. I think the good thing is that anything which invests 35% or less, so let's say there will be now hybrid funds which will come out, multi-asset funds which will come. They're all available in the market, but they will now assume a greater degree of importance in your portfolio. So hypothetically, in the past, if I had 100 rupees to invest, I would decide what my allocation should be, right? Because I could say technically saying I'm a more longer term investor, so I would like to have maybe 85% in equities, maybe 15% in debt. Now, given that that 15% does not enjoy the tax, I'll have to go and figure out a hybrid fund where my whole package gives me roughly the allocation I want for my long-term investment. So I think the industry has the ability of doing this. I think we have a lot of flexibility around what we call our hybrid products. Now, unfortunately, one unintended consequence of this law is that two things have got changed. I think fund of funds, which largely invest in a basket of funds and then pass on the benefits, which were earlier treated as sort of debt fund under taxation, the taxation has gone there. And something very, very important to us in Axis, which I yet think is a brilliant opportunity, which is international. Any international fund is also gone. But most international funds use what we call the FOF, the fund of fund route to invest. Right. So like for example, today we have a fund called the S&P 500, which is actually the most diverse equity fund in the world. It gives you exposure to the top 500 companies in the world, right? And that was going through an FOF route. Prior to March 31st, that would have been treated as you would have got benefits in terms of indexation, in terms of lower capital gains. That's not there. But even today, I think if someone says that, hey, we have what we call a very strong domestic bias. I think in India, we invest more than 95% of our savings locally. We don't have, unlike other countries, including developing markets like Brazil or their whereabouts or South Africa, they put almost 30-40% of their savings outside their home country. So I think that argument yet stands. I think today there's a huge amount of investable companies which are not available in India, today because our markets are in a way a little behind or not representative of a lot of companies today. And that investment, if you want, that is yet available internationally. So I think apart from debt, I think the other opportunity also for investors is that any international investments that you make till 31st of March, that also in some sense qualifies for the old taxation. But having said that, I think very clearly there are huge benefits. I think there is a people like Devang who's on the call with me, who's been a decade plus in fixed income investments. We have what we call active fund managements, and active means that they take very, very smart calls on duration, which is the length of the investment of the portfolio. They take pretty smart calls on where they should be putting money. Should we be putting money in government securities or AAA corporate bonds or AA corporate bonds? And a lot of these investments are really not available very, very conveniently to domestic investors like you and yes, if you're a large corporate investor, then of course you do have a big you. If you have a large treasury and you have a large back office, then you can obviously manage a lot of the other options available to you. But as a local domestic investor, I think the thing is that mutual funds will yet play a very, very large role in your life, right? So I think today we have two things. I think sorry, I think Shoaib, I think your screen's gone off. Thank you, Shoaib. I think so. Basically, I think I'm not going to get into the debt MF taxation. As I said, lots of print, lots of media, lots of TV already dedicated to it. I think very clearly there are opportunities available post April 1st. It's not the end of the world. I think fixed income yet is a very, very important wheel in our investment car, especially given what's happening around the world today, right? I think if you have to have some level of stability in your investment portfolio, I think fixed income is a very, very important part of it. Mutual funds offer fixed income in a very, very convenient and risk managed perspective. Most of us, when we do traditional fixed income, we don't tend to diversify. I think our biggest advantage in mutual funds is the whole diversification pool, deferment of tax, the kind of flexibility that you have. And then, of course, if we really are concerned about the taxation element, I think hybrids, which is a combination of equity and fixed income, will play a very, very important part. But I'm going to have that conversation with all of you on a separate note, maybe after April 1st. Right now, as I said, the immediate opportunity, if you haven't already done it, is to go out and try and figure out which fixed income fund suits you. We have a set of things that maybe Devang will talk to you about. I think Devang is a veteran in our fixed income business. I think he's seen a lot of markets. So things like 2018 or 2020 COVID or even 2023, the whole Fed inflation story and everything is something that he tracks very, very closely. So I'm going to actually hand it over to him to sort of give a perspective on where he thinks markets are, what's the immediate fixed income opportunity, despite the investment opportunity. I'm not talking about the taxation opportunity. I'm talking about the investment opportunity now. And then obviously, I think he'll conclude with what we think are good products from the Axis Mutual Fund stable. And then, of course, like always, we have received a whole lot of questions from many of you, and we'll try and use this next 35 minutes, 40 minutes to try and finish as many questions as we can, right? So yes, thank you so much again for joining us on a working day. Yeah, Deva, over to you.
Thanks. Am I audible?
Absolutely.
Yeah, can you, Shwak, can you please go to the next slide? Yeah, so the next one, sorry. Right. So I think Raghav has covered the topic quite well, and I think the important logic was to come and address to all of you guys, because I think the critical questions which are arising in your mind is at this point of time what we should do probably post 1st April, what we should do as a fixed income investor. I'll try to give an overlay of macro also, because I think it is very, very important to understand that obviously not only the taxation angle, which has just happened a few days back, but overall how fixed income asset class as a perspective in your investment kitty today becomes so important. I would like to first highlight is that over the last 12 months, I think, and Raghav alluded on that point, if you actually invested post June 2020, just 3 months after COVID, and if you have looked at last 2 years returns on fixed income, I think the general consensus behavior is that the fixed income returns have been quite muted. Okay, and the 2-year returns have been, if you pick up any category, I think probably it has been around 4 to 4.5%. But the good, I would say, those days where probably the returns were so muted has is over now. Incrementally, if you look across in the last 12 months, thanks to the inflation concern, central bankers, not only in India, but across the globe, have been front-loading the rate hikes. If you look across at the entire pace of rate hikes, they have been significantly fast on jumping rates. We have seen Fed moving from almost 0 to 5% now. You look at RBI has moved from 335 operative rate to 6.5%. So there has been a significant change in the overall rate hikes as well as the monetary policy rates across global economies. Obviously, inflation being a concern, people were too worried about the easy liquidity which was sloshing away in the market and was creating bubbles. So I think all that created a significant surprise element, and we have actually sailed through that well. In fact, if you look across last 12 months, no one anticipated that RBI would be hiking or Fed would be hiking by 500 or 300 basis. But somewhere down the line, all of us were positioned, and across all segments, the duration element was very, very limited because we anticipated Fed or probably RBI to start unwinding the easy liquidity and the easy rate cuts which they had actually delivered because COVID was getting over. So despite 300 basis of rate hikes, rate increases, we've actually not seen significant mayhem in fixed income markets. Keeping aside, I would say if you look across at the macro trend now, I think we have been now telling for now almost 6 months that since October that RBI probably will stop at 6.5 and probably Fed also will look at a pause between 5 to 5.5. I think if I read across Fed, the last meeting, the policy, what Powell spoke after that in the press conference, if you actually look across at the minute details, we started believing that somewhere down the line, this contagion, the accidents which are happening on the global side, on the banking system, have all created somewhere down the line the fear in the Fed's mind that if they over tighten, they can actually lead to more accidents and it can be a contagion. The thought process is very, very clear that incrementally, yes, we should keep a vigilant eye on inflation, but we should not over tighten because any which ways credit conditions would tighten and which would be equivalent to rate hikes. So as per our understanding goes, looking at the macro, looking at the US global economy, I think as well as the other rest of the world, economies have started slowing down. Inflation, which was a big problem, have started showing a downward trend. And India also is a party to it. When you look across at the next near term 6 to 12 months inflation print, they're all going to be on the lower side. As well as from an overall perspective on growth, we have started seeing that if you look across and hear the corporate guidance, they have started seeing some kind of slowdown. So our view has been that actually as an asset class, today, fixed income makes a lot of sense for investors. Secondly, if you, the next slide, please, Sohar. If you actually look across at the curve today, the curve is very, very flat. I think if you look for the last 2-3 years in COVID environment, there was a big steepness being built in onto the curve. It was like 1 year was at 4.5%, 10-year GSEC was at 7%. There was a 200-300 basis of steepness because we had never witnessed such kind of liquidity. Today, we are back to almost a flat curve. You pick up 1-year CDs, you pick up 10-year corporate bonds, you pick up 30-year GSEC or 30-year corporate bonds. I think the curve is very, very flat. It's like between 1 year to 10 year, you can actually look at the curve. It is everything is between 775 on the corporate bonds or CDs. And if you actually look at the GSEC curve, it is everything between 720 to 740. So the curve being so flat, and the overall perspective for us is that this because of all the factors. One is inflation slowing down, global cycle somewhere down the line peaking out on interest rates, growth conditions started to weakening. I think somewhere Fed has already shown sign of pivot. Okay, though they have done a hike, but I think probably it's a hike where they themselves thought about a significant pause in the last Fed policy. So I believe so. Fed have already started to look at pivot. With that thought process, we believe that RBI even if it delivers a 25 basis hike, I think this would be the last hike in the monetary policy, and hence incrementally from here on, we believe that the worst of rates in this cycle is broadly over. Now, keeping that base fundamental view of the curve being flat, macroeconomic environment, when it comes to growth deteriorating, when it comes to inflation showing a downward trend, and I think RBI's projections as well as all economics projections are showing that next year inflation would be closer to 5.5. With that at 675 kind of operative rate, between 6.5 to 675, you're already at 100 basis real rate. Don't look at the repo rate. I think when you're looking at the absolute rate where you are investing today, anything beyond 1 year to 10 year, I think you are getting at least 7.5 plus on carry. So the curve becomes very, very attractive, and that's been the case for us. And hence we have been very, very bullish on the fixed income asset class at this point of time. And we believe that investors should have a part of their investments or larger part of their investments into fixed income. With this change, I think the taxation change, the only thing which happens is the urgency of the matter. I think the urgency has become now somewhere down the line, you have to invest in the next few days to get that benefit of the taxation, and probably whatever investments are done prior to 31st March, probably they will have that grandfathered impact, and which will help you not only from an overall macro view perspective, but also you can avail the tax arbitrage opportunity. So our thought is that at this point of time till 31st March, we believe that if given a choice, we at this point of time advise clients to invest in all kind of open-ended active funds. Because the curve is very, very flat, we are advising the short to medium term segment at this point of time, which we believe makes a lot of sense for clients. Incrementally going across post 31st March, I think the another important case and why we should continue to invest in fixed income funds, I think that's been the question. I think there were two reasons. One more important point was obviously the tax efficiency which investors were getting. But the second other important aspect, and which is very, very critical, was which Raghav alluded on, was the liquidity and the diversification of the portfolio which mutual fund offers. Like at all point of time, if a corporate treasury or retail client wants to invest and just remove money, park money for emergency, for taking tactical views on interest rate cycle, I think mutual funds offer a brilliant platform, not only providing liquidity on T+1, but also giving those benefits of riding the interest rate cycle. So our perspective is that incrementally from here on, like if I look across at the last 2-3 years post the DHFL, ILFS crisis, a lot of investor money has started going into passive strategies. From here on, what we see after 1st of April, I think a large part of investor money will start getting attracted into active managed funds, which will be all about how much alpha that the fund manager and the fund house deliver. So the thought process for us is that active funds will gain a lot of popularity back, and the thought process will be that investors will ride not only the interest rate curve, but also continue to keep investing in various parts of the fixed income segment, depending on their view on interest rate cycle. With this, next slide, Shoaib, please. With the yield curve being flat, I think incrementally you will also start seeing a lot of play on credit. Okay, and thanks to SEBI and whatever episodes we had post DHFL, a mutual fund as a platform have significantly diversified their credit risk for portfolios. Not only they have significantly diversified their credit risk portfolios, but also somewhere down there, if I look across at the element, there has been a significant percentage of liquidity being built in. So huge liquidity, diversification, laddering of the portfolios. I think the shape of credit funds incrementally has significantly improved, and that is another play which investors will start looking at. My understanding is incrementally, when investors invest in fixed income funds, they will look at three to four critical aspects. One is the significant importance of diversification, significant importance of T+1 liquidity. The third aspect is that somewhere down the line and significant outperformance over relative substitutes, which are FDs and other options which are available for investment. And last and more important play is that the time and criticality of interest rate view which you want to execute. I think the best option which would be available is still mutual funds. So keeping aside the 3-4 elements which I just spoke about, we believe that investments for post 1st April will be all directed towards active managed funds, and specifically where the thought process would be to either ride the interest rate cycle and somewhere down the line deliver that outperformance. Can you move forward to the next slide? If from our perspective, I think till 31st March or after that, these are the category funds which are short to medium term categories which we are advising clients. The first 3 categories are specifically for short to medium term investment horizon. The last 2 categories being longer duration in nature is specifically advice for investors who want to probably park their money, keep them, and who have a very, very longer term fixed income investment horizon. And the thought process for them is just park my money and stay put over the next 5 to 10 years. So long duration fund is a 2052 roll down strategy. Dynamic bond fund is a 2030 roll down strategy. The other three funds, which is short term strategic, are more active funds into the short to medium term category, which we believe so will start getting lots of, I would say, attention post 1st April. Axis Banking PSU Fund is a AAA 2026 roll down strategy. So the basket of, I would say, roll downs and active managed fund is in the short to medium term space is what we are advising currently at this point of time, keeping the macro view as well as the changes in the taxation guidelines. What I'll do is I'll stop here and we can just hand it over to Shoaib or Raghav for questions.
No, I think we have a set of questions here. So I think maybe Shoaib has curated a few of them. I think we have some time to take a few of them, Shoaib. So maybe you could start.
Yes, we actually got more than 100 questions. So I'll just list out 3-4 of them. One of the questions that we have got is that will we be having any product, or will we be changing any product to 35% equity, and which will come under indexation?
I think that's a question that we'll answer post 1st April. Right now, I think there's one idea which is what we call, which to be the earlier, monthly income plan, which is conservative hybrid funds, can go up to 25% equity. As of now, in the current regulatory limit, I think there is some conversation that maybe that can go higher, obviously subject to regulator approval. That's one. Otherwise, there are these equity savings funds, which typically put between 20 and 45% in actively managed equity, and the balance in arbitrage funds. So as a total, they give you 65%, and that could be also another slightly lower risk element in the two sort of, it's not exactly debt substitute, but these two are possible. I'm sure the industry will come up with some interesting ideas. We have some ideas, and I think right now, as I said, Shoaib, the immediate opportunity is to try and go and get something going by 31st March to take advantage of the current tax regime.
One of the investors is asking us that if someone wants to invest from a 5 to 7 years perspective, and they don't intend to actually use the money for that period of time, will it make sense to choose one of the either the Axis Dynamic Bond Fund, or should they go for a long duration fund?
So I'll take this question.
Yeah, they want to.
Yeah, for a 5 to 7 year investment, if you ask me, Axis Dynamic Bond Fund is the best product because it actually matches the entire requirement, investment horizon also. I think one critical aspect which investors always should keep in mind while investing into debt funds is that match their investment horizon with the product. I think they will have a beautiful experience all throughout. So for this investor specifically looking at 5 to 7 year investment horizon, Axis Dynamic Bond Fund, which is a highly quality biased 7 year roll down portfolio at this point of time, makes perfect sense.
Thank you, Devang. Another question that we have got is that there are 2-3 retirees who are asking as to which basket they should be choosing. They are all in the 30% tax bracket, and their primary question is that what would be the right way of investing in debt fund right now for them?
I think that's a good question, because my dad is also in that bucket. So right now, what I've told him to do is to sort of take out whatever he can, beg, borrow, and put the money into as long a duration as is convenient for him. So, I mean, he is very comfortable with the dynamic bond fund and with the long duration fund. So he's gone there. So that's an advice that's coming right from me personally. But yeah, I think we must understand that dynamic bond fund, long duration, both have reasonably long durations, as can be seen in the slide. So any interest rate volatility, if it goes up, will affect the NAV. So you should not allow that to affect your mood, if I may use this term, because many people get very worried. All investors, all retail investors get very worried when they see negative returns in their debt portfolio, and that can happen because we are part of This is a capital market portfolio. Capital markets are very intertwined with what's happening locally, globally, politically, economically. Debt is one very, very sensitive asset class. It gets hit by many, many factors, many of which are quite alien to retail investors, right? So most people will not understand as to why a collapse of a SVB bank should affect our debt market, right? You can understand on the equity side, but debt market, I think as an industry, we've not done a good job of explaining it to them. So I think keep that in mind. I think most of the investors in this category, ideally, Shoaib, should sit in the first 3 funds, which is short-term banking, PSU, and strategic debt. Because I think given what Devang pointed out today if you remember the yield the yield curve, the lines, the squiggly lines that we showed you is basically the yield curve, which is basically if you plot what you get for 1 year, 2 year, 5 year, 10 year, 30 years, etc. That was what the yield curve meant. You would see that there's a sweet spot somewhere between the 2 years and the 5 year space. That means that you're not taking too much what we call interest rate risk represented by duration. At the same time, you're not sacrificing too much return because the returns on those bonds are also quite similar to what you would make, let us say, for a 7, 8 year, 10 year period. So again, retirees ideally, yes, I think should go there. I think even today, the biggest advantage for a retiree compared to other fixed income instruments is that, yes, I think you can do what is called a systematic withdrawal plan. I think today, again, you get taxed only on the amount of money which actually you take out, right? Your cost price minus actually what you take out. That's the element of tax that you pay. In the past, of course, and I mean, we yet have 48 hours or maybe 72 hours left for that thing to happen. 31st March is yet there, and we can use that. But assuming you miss that deadline, that's fine, because I think you yet get that benefit of SWP. Most retirees are also not in the very high income tax paying bracket. So you substitute some element of certainty which you get in other fixed income instruments in terms of return with the flexibility and the diversification of a mutual fund. That's the broad trade-off that you will have to do as a retiree. So I think my suggestion is you should need to have a mix of both. You can't be 100% traditional, nor can you be 100% MF, because I think both have their advantages and disadvantages. I think if you have a mix of both, I think that will add to a very, very good investment experience.
Thank you, Raghav. We'll take two more questions. So the second last question is fairly interesting. So the gentleman is actually asking if between active and passive, whether they should be looking at passive at all, especially the ones which are closing in 26, 27.
Let me try that. I think maybe Devang can come in after that to add to this thing. This is my favorite question because I think earlier I used to be very happy with passives because it sorted a lot of my investor queries, right? Because passives give you an index of securities. The fund manager, the fund manager has to follow that index. There's no leeway for him or her to move aside. You know that you have a certain duration. It's 26, 27, 28, 29. You have it all the way. The trick in passives is that once the investment gets done, it matures, right? Then what happens? Then you're going back to the whole circle again. So I think today, if I was there, I would, as of now, maybe prior to this amendment, I would have been maybe 50-50 in passives and actives, because again, there, in my experience, I have seen good fund managers from reputed fund houses, specifically people like us, give very, very good what we call alpha, which is outperformance over various other asset classes by managing the portfolio actively. So in the past, maybe before this, I would have said do a 50-50. Today, I think you have these advantages where you have a banking PSU debt fund, which is largely like what I call an active passive fund. It has a certain investment style, and that style allows a little bit of predictability. It also invests in 100% AAA largely, and it is perpetual. So it will never close down, unlike a index fund or an ETF, which once the year gets done, it gets over. Or the same thing goes, for example, a dynamic bond fund, which we use what is called a roll down strategy, which is a 10-year, slightly longer, but again, which will never expire. So I think we need to be in products which have some predictability, and also more importantly, do not have an expiry date. And unfortunately, in passive funds today, there is an expiry date, whether it's 26, 27, 28, 31, 32, whatever it is. I mean, at some point of time, that product will lapse, right? And when that product lapses, at that point of time, you will have to, redo your entire investment proposition and get back. So I think for the next 48 hours, definitely, I think what I call active passive funds like Axis Banking or Axis Dynamic makes a lot of sense. But even post 1st April, I think as like Devang mentioned, I think the actively managed portfolios will start raising their head. And I think that is what will actually give investors hopefully a better fixed income experience. Devang, you want to sort of add you want to add anything?
No, I think you covered it quite well. If you ask me personally, I'm not a big fan of passives. My understanding has always been that passives is somewhere where, or probably mutual funds were also used because It was more a tax efficient solution. We are not getting any alpha for the investor. So these were Me Too products for the investor as far as their requirement goes. See, at the peak, you also need to understand, you need to marry the macro along with the fixed income rate view. Today, at a peak of the interest rate cycle, a passive fund will stick along with what the index tells you to do, what is the maturity, whatever is the index part buying or elements or constituents of that, you can only buy that. An active fund will allow you to take those interest rate calls, maneuver the fund between GSEC, corporate bonds. As I think Raghav alluded at the beginning of the thing, we can move along with AA, AAA credits, everything. So I think incrementally, any which ways, if the tax efficiency goes, passive products and the other substitutes, there is not much difference. So I would probably believe so, that except for liquidity. Okay, so passive funds do give you a T+1 liquidity at all point of time, then it is diversified. But from an overall return perspective, I think active funds always deliver and probably will, over a longer period of time, they always outperform passive funds. So our understanding is incrementally the game would be more about alpha generation, and hence active makes a lot of sense.
And so we'll take one last question, and this is more of from a macro perspective. So the question is that how do you see the interest rate impact or the interest rate moving along over the next 1 to 2 years time? Since we are locking in for 3 years, I think their focus is to understand how they should be looking at interest rate for the next 3 years.
Actually, Shoaib, I like to just correct that question. I don't think it's a lock-in for 3 years. I think now any money that is sitting in your debt funds, or you have managed to invest by 31st March NAV, I think will become like family jewelry. You should not touch it forever. I think it's a sort of a redemption at last resort, if I were to put it this way. Very large investor friend of mine actually told me that he said it's your debt funds, anything which is invested already, or maybe till 31st March to take advantage of this old tax regime, which actually becomes like your family gold. All of us know that we don't touch our family gold unless something unfortunately very, very adverse happens. This will become like that. So that's a correction, Joe. Well, it's not 3 years. So it's actually lifetime. And now the second part I'll leave to Devang to answer. Devang, interest rate view is your big.
Yeah. So see, my understanding is currently, as I told you, our expectation on inflation is, and probably we are very close to RBI's expectation. If I look across at the numbers, we believe so. CPI will be in the tune of around 5.25 for next year. Okay, and we are seeing inflation being sticky. So if I was RBI, I think probably what we would think at this point of time is that if inflation is not coming significantly lower, okay, and we have not hiked as much as global markets, right? Global markets have hiked by more than 500 basis. So for us, I think yes, we stop at 6.5, 675, but rate cuts also might be delayed. I'm sure that there's a lot of conversation which happens all throughout, that the interest rate differential between US and India today would be I would think, one of the minimals. Okay, the gaps are significantly reduced. And why that is because we have seen, actually, this is the first time in history that we have seen for consecutively 18 months US CPI higher than India CPI. It's never happened. So I think what will also start is that Fed probably will start pivoting first. Fed will start cutting rates first. So for us in India, if you ask me, in the near term, looking at the macro, because we have not hiked so much, okay, as compared to global markets, I think first the developed markets will start cutting rates and probably India will follow the suit. So for 2023, we believe that after this hike, we would be mostly on a pause mode for most part of this year. 2024 is where we start believing that, looking at the macro, and our estimate of growth is significantly weaker than RBI. RBI is very positive. I think I have not seen as optimistic RBI ever in my life as it was in the last monetary policy. They were very, very positive on the external environment. They were very positive about growth, and they have done a superb job. So our understanding is next year, probably they might be slightly more optimistic on the growth front. And we believe that growth numbers can be significantly lower. Our estimate on GDP for next year is 5.5 versus RBI estimate of 6.5. And that is probably will lead to RBI cutting rates. So I think 2024 is where probably we start seeing rates getting cut. Where do we look at medium-term rates in India? I think to fall below 6% on operative rate and 675 kind of on 10-year looks difficult with the kind of borrowing program and stickiness of inflation. So I would not attribute more than 50 to 75 basis of cut in the next financial year. We are talking about April 24 to March 25.
Okay. Do you think we can take 2-3 more questions?
Yeah, I think 1-2 more questions is fine, sure.
Okay. So one of the gentlemen is actually asking if they should move emergency fund to your to the strategic bond fund or banking PSU fund. So I think currently their emergency would be parked in liquid fund. So they are looking at if they should actually move out to.
No,
So
I
take this question.
I am sorry. I don't agree with that. I don't think one should do it because emergency means that you need money at a reasonably high possibility. You don't know when you'll need it. That's the whole criteria of emergency. At that point of time, God forbid, if there is some interest rate problem or something happens internationally or something, and the world is quite a complicated place. So one doesn't want to have use the emergency money also at trading at a bit of a loss. So I think no, that we should not do. The same liquid fund logic applies to the taxation rule applies to liquid funds also. Sure. So if you don't touch it for 3 years, 4 years, 5 years, you don't pay any tax. Number one. Number two, if and when you take out whatever you take out, I'm assuming the gentleman has already got his money invested, then I think he anyway gets the benefit of indexation. The other second thing, most importantly about emergency funds, is it similar to my conversations on SIP, right? We all start SIPs at a certain number. We start, let's say, we try and put maybe, let's say, most people start at 3,000-4,000 rupees, but as their income grows, they don't top up their SIPs, right? And I think that's the key thing that we need to do in an emergency fund also. That, your emergency fund, if you're one of the few smart people who've already done it, and for the rest of you, including me, by the way, I don't have an emergency fund. One of the things I keep thinking about is my emergency fund. Fortunately, my wife maintains something, so I'm sorted in that sense. But yes, for us who have not done it, I think we need to keep checking our expenditure on a monthly basis and make sure that at least every once in 6 months, 1 year, you're topping up that emergency fund also. So for me, emergency fund is very, very low duration, high quality assets. Liquid fund fits the bill. Like Devang mentioned, I think even liquid funds now have a portfolio yield of more than 7%, right? And I think with what is happening in markets, especially in the last 2-3 days, and hopefully for the next few months, I think that 7% looks pretty, and it's a good number to have. So that's not a worry. Devang, if you have a contrary view, I'm happy. I think people will be happy.
Emergency funds, I agree with Raghav. I think emergency is something which is you are requiring it overnight. So there we should not probably go to this thing. If you have the slicing and dicing of emergency funds into something which you probably want to keep it into overnight and something which you can want to switch it, I think that possibility is there. And short-term and strategic, I think both are very medium-term funds. Okay, short-term, medium-term funds with a very 2 to 4 year duration bucket. So I don't see any challenges between the two. The choice of the two, I would be indifferent towards the two. Okay, one has a slightly higher element of double and nothing else. Okay, so I would be indifferent towards the choice, but I completely agree with Raghav. What is emergency is emergency. You need to park it and keep it for at an overnight liquidity, and you don't want to take any duration risk there.
And we'll just wrap up with this last question. So I think Raghav sir, you should be answering this as in why people should invest in debt fund now and not in FD, because there are no tax differences.
No. So I think at Axis, the thing we've been talking about debt since November 2022. We did a very, very extensive campaign around why debt is important. I think both have their advantages. I'm not going to say one is better than the other. You need to have an and portfolio because I think what FDs give you is a certainty. And in today's environment, I think the rates are pretty decent, right? But there are points of time because ultimately FD is demand and supply. When a bank needs money, they will take interest rates higher. When they don't need it, they will bring it down. That we have seen that cycle in 2020, 2021, bank FD rates were very, very low. That's the advantage with fixed income or mutual funds, because as I said, mutual funds returns are a component of the price movement of the security in which the portfolio is invested, and of course the interest that it generates on that security. So it's not only two. So you have a benefit of both. And of course, the other things which I spoke about in terms of diversification, liquidity, paying tax or paying income, your income accruing only on the amount of money that you actually take out. So those are some advantages of MFs with this. I think post 1st April, I think the important thing is to have a bit of both. And I think investors are smart enough to figure out at which bucket, what makes more sense for them. So obviously, if a bank FD is giving you very good rates on a 12-month, 18-month kind of a portfolio, obviously some money should go there. Remember also that there are breakage costs. So suppose one needs to get out after 6 months, 9 months, there is a cost to it. It's not just simply going and tendering stuff, right? All that is missing in a MF. So that's the good thing. The flip side is, of course, because MF returns have a little bit of volatility to them because of the price movements. You may, if you keep it over a long period of time, you will come very close to what you want to make. But in the short term, you could have fluctuation, which could sort of upset you. So I think, sure, I'm going to take the mid path here, and I think I'll leave it to the investor to decide. But I think a bit of both is useful, of course. And then once in 3 6 months, keep reevaluating that, right? So if bank FD rates go below inflation rates, then obviously one needs to rethink that allocation and vice versa. Correct. So I mean that's that. Thank you so much again. I think this was a very good session. I was a little worried. I hope this made some sense to all of you. We were thinking of doing this over the weekend, but we were hoping also that we let the dust, as they say, settle down. Of course, a lot of stuff has been written. If we had done this call on Saturday, if this would have become more of a taxation call, please understand debt is not only about tax. Mutual fund debt is not only about tax. I think mutual fund, fixed income mutual funds are a very, very important part of your overall asset allocation. You must have some money there, irrespective of whether tax benefits are there or not there. I think, yes, we did lose some benefit over the weekend, but I think what has happened, what most people have tried to cover is the tax part of it. I don't think, as I said, tax is only one small component of it. The other things one must keep in mind, which is the diversification of portfolio, very, very important in debt. The liquidity, again, super important in debt. And of course, for investors, the ability to pay tax whenever you take it out. So if you're keeping money for 10, 15, 20 years, you don't really pay tax on that gain till you actually remove it. So it's a great way to build a retirement corpus, build an emergency corpus, build a short-term goal corpus. All these things yet require a fair element of debt funds there. And I'm sure, I think all of us I think especially at Axis, we'll come back to you with a few interesting solutions once this whole April 1st deadline gets done. Please try and see if you can finish off whatever you can invest over the next 48 hours. I know March is a very, very bad month for additional cash because I think your HR departments will be after you. You need to save money for your income tax, for your 88, Section 88, 80C. There are lots of other insurance premiums and everything gets unfortunately collided together. But yeah, whatever money you can take out and keep, I think that's an advantage for all of you. If you don't, no worries. I think debt funds are not going anywhere. Like Devang rightly mentioned, I think there's a big, big advantage in actively managed debt funds in a retail investor portfolio. And I think that will keep coming up and we'll keep talking more about that in the next month and months to come. So great opportunity to invest in debt from a macro. Obviously, the next 48 hours will be great from a taxation perspective. But if that doesn't happen, no worries. Don't sweat. I think there's a long way to go in your investment journey. So yeah, so be well, please invest well. Thank you so much again on behalf of Axis for joining.
Thank you.
Thank you, sir.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.